One of the schemes I had invested way back in 2016 was the ICICI Prudential Long-Term Fund. The scheme had delivered over 18% returns in 2014. 2015 was a bit sedate at 6.1, but then it recovered in 2016, and for that year I enjoyed a 16.8% return. Now, your initial reaction might suggest this is an equity scheme. However, this was actually a debt scheme, and the phrase long-term merely represented the nature of instruments it held, that is, Government of India papers whose maturity was 9, 10, 11 years away. We'll understand this part in greater details, but just to close loop the story, this fund, which is now called the ICICI Prudential Long-Term Bond Fund, delivered 5 and 7% in the next 2 years, around 12% in 2019 and 20, just around 1% in 21 and 22, and is just about matching inflation with a 7.3% return in 2023. So the range is high, 18% at its highest and 1% at its lowest. And as you might have guessed it by now, this flippant behavior is all to do with the interest rate cycle. And if an investor plays this part smartly, one can make up to 15-16% in returns, which is double of the 7 to 8% return that we currently make on a fixed income instrument. Understanding if and why this is possible and how to do this will be our quest for the day. Let's begin. Okay, let's start with something foundational. What is a bond? Well, a bond is simply a loan. And who needs a loan? Well, everyone needs a loan, but especially institutions like banks, companies, NBFCs, home loan providers, and of course the state and central government who needs money to support their welfare schemes, salaries, defense, subsidies, infrastructure building, and much more. In fact, the centre is expected to borrow a little over 14 lakh crores in the coming financial year, and a lot of this borrowing will happen via the issuance of treasury bills and government securities. That's also called a GSEC. So when we buy a bond and by extension a debt fund, or when we invest in an FD, we are actually lending money to an institution, and in return we receive a coupon and interest on the principal, which is currently between 7 and 8%. But note here, just because we have money to lend doesn't mean that the other party has unlimited borrowing capacity. In fact, too much money in the system can lead to things like high inflation, asset bubbles, the weakening of the rupee, etc. And so this becomes the RBI, the Reserve Bank of India's responsibility to regulate the supply of money within the financial system, which it does using the benchmark policy rate or the repo rate. Now, because there is something happening all the time, the supply of money keeps on changing, which means our country's repo rate is always in a state of flux. To put flux in numbers, since the year 2000, the RBI has changed the repo rate 77 times and is currently at 6.5%. So the big question is, what has this repo rate, this RBI interest rate, to do with the price of a bond? Let me explain this with an example. So in theory, the price of a bond is the summation of its future cash flows discounted back to its present value. For instance, say I have this fixed deposit that gives me an interest of 7%. Now at the end of 1 year, I'm supposed to receive a maturity of 1070 rupees, which means the current price of this FD, this bond, is 1070 divided by 1.07, which comes to 1000 rupees. Now if we do this as a multi-year exercise, then step 1 is where we list down all payments that are yet to be received, which includes the interest payments and of course the principal. And step 2 is where we calculate the present value of these cash flows and sum up the numbers. As an example, let's say I've bought into a recently issued 3-year bond and it pays me a 7% interest, which means at the end of year 1 and year 2, I'll receive 70 rupees, and at the end of year 3, I'll receive 1070 rupees, that is an interest of 70 and a principal of 1000 rupees. Now for calculating the present value, if I assume a discount rate which is equal to the RBI interest rate of say 7%, then the present value for those 3 years, that is 65.4 rupees for year 1, 61.1 for year 2 and 873 for the third year will all total to exactly 1000 rupees. But let's say the RBI suddenly and without warning reduces the repo rate and makes it 5%, which means our discount rate goes down and this bumps up the present value numbers, which means 65.4 becomes 66.7, 61.1 turns to 63.5, and the year 3 calculations go up to 924 rupees, which as a total comes to 1054 rupees. In other words, a 2% drop in the interest rate has lifted the price of this bond by 5.4%. So essentially, this is an extra gain of 5.4% to the bond investor on top of the interest that he or she will anyway make on the bond. And that's what I meant by the remark that fixed income investors can make a lot of money by taking advantage of the interest rate cycle. We'll definitely look over the specifics in the coming section, but another service you can take big advantage of and that helps you save a lot of money is mStock, the sponsors of this video and one of the few stockbrokers in the country that have built a zero brokerage model. Yes, you heard that right, zero brokerage, which means there's free intraday, free delivery, free F&O, free mutual funds, free IPOs and a lot more. And all of this can be yours by paying an account opening charge of just 999 rupees. Yes, just 999 for all this free stuff. And if you pay another 999, then you can also get rid of those quarterly AMC charges for the rest of your life. In fact, the mStock website has this detailed comparison table. And if you're someone who is into intraday, uses futures and options, does margin trading, which incredibly at mStock can be as low as 6.99%, then definitely check out mStock as it will help you save a lot of money. But money isn't everything, right? Trust is equally important, and presently mStock is backed by the Mirai Asset Group, which needs no introduction. It has over 8.5 lakh users, it did over 3.5 lakh crores of turnover and is estimated to have saved 145 crores in brokerage last year. So save it, trust it, compare it, and don't forget to try it. As always, the link to this platform is available in this video's description. Alright, so let's move from theory to practical, and as far as interest rates are concerned, the RBI has jumped and stalled over the last 2 years. For instance, the repo rate was gradually hiked by 2.5% from May of 2022 until February of 2023, but since then the rate has been kept steady at 6.5% with the most recent meeting of the MPC, the Monetary Policy Committee, taking place in February of this year. So essentially, we as investors or fund managers or as financial advisors have to have a view on where the interest rates are headed, and to help out, I've researched and isolated the key factors that can have a meaningful impact on where the repo rates might be headed in the year 2024. The first factor is what's happening in other parts of the world, and presently a growing number of central banks have put a pause on rate hikes, and some of them are even cutting down on interest rates. The general perception is that many more central banks, especially in developed economies, will start reducing rates from the second or third quarter of 2024 now that inflation, which was 10-12% in the US and Europe, is a lot more manageable at 3 or 4%. In that context, most debt fund managers in India believe that the rate cuts here will start only after the easing cycle has begun in advanced economies, and the US Federal Reserve's FOMC meeting, which is to be held on the 19th and 20th of March, will be a much awaited event. However, irrespective of whether the FOMC cuts interest rates or not, this is unlikely to lead to an immediate response by the RBI, and most fund houses believe a rate cut is still a good 5 to 6 months away from now. A second factor, and something that the RBI looks at very intently, is the rate of inflation. Okay, so a little theory, and as per Economics 101, when the price of goods and services rises too quickly, a standard response by any central bank is to increase interest rates. That in turn reduces borrowing and reduces spending in the economy, which consequently brings down the country's inflation rate. The data here suggests that although inflation is on the higher side, it has definitely come down in the last year or so. For instance, retail inflation or CPI, which was 7.4% in July of last year, is down to 5.1% in January of this year. But I must mention the number RBI is really gunning for is 4%. Similarly, the core inflation has come down from 6.5% to 3.5% within an year, and these are promising signs for the RBI to consider when deciding on the repo rates. In fact, I read this note from Tata Mutual Fund where they estimated the real rate, that is the difference between the repo rate of 6.5% minus the estimated 1 year forward CPI of 4.5%. This difference is now 200 basis points, and because the RBI generally targets a real rate of 150 basis points, this opens up space for a 50 basis points interest rate cut over the next few months. The third variable for us to consider is the Government of India's newly discovered financial prudence. You see, every year the central government borrows a lot of money to finance its expenditure, but this year was slightly different, and the government showed some restraint in its interim budget by pegging its FY25 gross market borrowings at 14.1 lakh crores, which is a lot lower than the 17.8 lakh crores that the government has budgeted for the current fiscal year. Of course, the main objective here is to reduce the fiscal deficit, which is estimated at 5.8% of GDP for FY24, with the government targeting a 5.1% number for FY25 and a medium-term target of 4.5% for FY26. So essentially, a lower borrowing target means there will be fewer bonds in circulation, which will not only lead to a decline in yields and therefore higher bond prices, but it will also give the RBI some more confidence in considering interest rate reductions later this year. A fourth factor that's likely to contribute to a lowering of the interest rates is the inclusion of Indian government bonds in the JP Morgan Emerging Market Debt Index from June of this year. This announcement was made in September of 2023, and since then the demand for Indian gilts has shot up, with foreign investors having bought over 65,000 crores of it in the past 5 months. So the deal is Indian bonds will start off with a 1% weightage in this JP Morgan index, which will then be increased by 1% every month until it reaches 10%. And the general expectation is that some $25 billion of FPI money, which comes to over 2 lakh crores in Indian rupees, will go into government securities due to this inclusion, and this is likely to bring down bond yields. In addition to the four major factors, the RBI also considers things like an increase in indirect tax collections, growth in corporate earnings, the GDP growth and forecast, which by the way has been recently upgraded from 6.5 to 7%, benign commodity prices, high foreign currency reserve, the softening of the crude oil prices, etc. And it's a combination of all these factors that the RBI takes into account when deciding on the repo rate. Okay, now that we've examined the multiple factors that have a bearing on the interest rate, let's understand what the general consensus is coming to. So firstly, a rate cut is still a few months away, and most fund managers expect the RBI to start reducing the rates from the second half of this year, maybe around the month of August or September. Of course, this would be preceded by a change in forward guidance and a stance on liquidity that RBI generally communicates via the MPC. And while this is just a crude indicator, even in the February MPC, while 5 of the 6 members voted to keep the repo rate unchanged at 6.5%, one member did vote for a 0.25% rate cut and a change in stance. Yet another indication that a rate cut might happen in the second quarter of the coming financial year comes from the Reserve Bank of India's own commentary that inflation, that CPI, is predicted to be 5% in quarter 1, 4% in quarter 2, which is the magical number, 4.6% in Q3 and 4.7% in quarter 4. Optimistically, if these numbers improve from here, plus if some of the other factors we discussed like the global rate cut materializes, then the probability of rate action improves even further. But for now, the best case scenario is the RBI welding the repo rate axe in quarter 2 of the coming financial year. A further consensus amongst most bond managers is a 0.5 to 0.75% reduction in repo rate, although one entity did predict a 1% cut. That being said, if a 0.75% rate cut does happen, then per the simulation from Kotak Mutual Fund, where they have assumed a current yield of 7.5% and a duration of 10 years, the 1-year return, that is the yield plus the capital appreciation, will total to an absolutely delicious 15% return. And if interest rates were to fall by 1%, then that number could go as high as 17.5%. To be doubly sure, I also came across some indicative numbers in an Economic Times article, and here the predicted 1-year gross return was around the 12-13% mark, with 7 to 8% being the coupon yield and another 4 to 5% coming from mark-to-market gains. And then to be triply sure, I even mapped the performance of ICICI Prudential's long-term bond fund across different time periods, and as one can observe here, interest rate reductions have been rather profitable to long duration bond investors. Which brings me to the question, what can we as investors do here? Well, it goes without saying that some part of your tactical debt allocation needs to go into instruments which have a longer maturity of at least 10 years. This can be done via debt mutual funds or bonds, and my limited tax experience says that listed bonds are better for most people because the long-term capital gain on them is taxed at just 10%, while debt mutual funds are taxed as per your marginal tax rate. But taxation apart, the chances of a 0.5% to a 0.75% reduction in repo rate, the chances are quite ripe, and investors can confidently take advantage of the same by allocating some part of their fixed income portfolio to long duration funds for the next 1.5 years. If you're a bit 50-50 about it, then you can do it in a piecemeal way by creating 2 to 3 buckets of different durations. So say a bond with a 5-year maturity, another with a 10-year, a third one with a 15-year maturity. And as things become more visible, more clear to you, you can change the allocation accordingly. In fact, there is some interesting data around this, which shows that government bonds tend to rally a few months prior to RBI's actual repo rate cut. For example, while the RBI started reducing interest rates from January of 2015, the actual decline in bond yields and by consequence an increase in bond prices started 8 to 9 months earlier from April of 2014. The same thing was observed in 2018, which indicates that probably now is a good time to consider investing given that we are about 5 to 6 months away from that RBI rate cut. Alright, so let's recap. Number one, this rate cut opportunity is suitable for long duration debt instruments like government securities with a maturity of 10-15 years. The point being, longer the bond's tenure, higher is the interest rate sensitivity. Secondly, there are multiple factors that the RBI needs to consider, but to pinpoint if the global rate cut starts in the next 2 to 3 months and inflation goes down to 4% as predicted for Q2 of FY25, then the RBI will find a lot more comfort in reducing rates. Thirdly, there are definitely some tailwinds, which includes an increased interest in Indian bonds and the government's initiative to reduce fiscal deficit. And finally, investing in listed bonds gives you some tax advantages, so it's worth keeping an eye on. As always, please do your own research. Play this as a 12 to 18 month tactical opportunity. And if you aren't sure about any of this, then please do consult a good financial advisor. Once again, thank you for your time. Do like this video. Do share it with your friends. Please subscribe to my newsletter and I'll see you very soon. Until then.
Investments in securities markets are subject to market risks. Read all the related documents carefully before investing.